This series of the 2025 50 Faces podcast is supported by Eagle Point Credit Management. Eagle Point Credit Management is a specialist investment manager principally focused on income-oriented credit investments in niche and inefficient markets. Currently, they believe that Eagle Point is the largest investor in CLO equity in the world and one of the largest non-bank lenders focusing on providing financing solutions to credit funds. This series is supported by Benefit Street Partners. Benefit Street Partners is a leading global alternative credit asset manager offering clients investment solutions across a broad range of complementary credit strategies, including direct lending, special situations, structured credit, high-yield bonds, leveraged loans, and commercial real estate debt and equity. As of December 31st, 2024, BSP Alcentra had 77 billion of assets under management. Our next guest is Head of Structured Credit at Benefit Street Partners, one of the sponsors of this series. Hear from her about how she moved from studying math into the sell side and now the buy side of this complex yet fascinating area. I'm Aoife Devitt, and welcome to the 50 Faces podcast, which showcases inspiring professionals in the world of investment and beyond by focusing on its people and their stories. I'm joined today by Cathy Bevan, who is Head of Structured Credit at Benefit Street Alcentra. She's spent most of her career in credit structuring. Welcome, Cathy. Thanks for joining me today.
Hi, thank you.
Well, let's start a little bit about your background. I presume you didn't grow up knowing you wanted to work in structured credit. Can you talk us a little bit through your career journey, going right back to what you studied at university?
Yeah, I definitely did not. I don't think I'd ever heard of it. So I enjoyed maths at A level. So that's what I decided to study at university. And I really didn't have any idea what I wanted to do after uni at all. I think when you do maths at uni, people talk to you about investment banking, accountancy, actuarial work. And I guess I didn't really know which of those was going to be interesting for me. I was really naive about the whole grad scheme, internship stuff, like as in it's almost a bit of an industry now. And I really didn't get that. I think I didn't have much coaching there or any kind of guidance from anybody. Nobody in my immediate family have been to university in that kind of normal way, like going straight from school into university. So I really didn't know how any of it worked. I tried out accounting as like a summer job and thought that was really very boring. So that was a no. I worked in the consulting division at IBM for a year after university, but I didn't really get what we were trying to do or what that was about. So after a few months of that, I applied to do a master's in maths at Oxford and to the graduate scheme at CIBC, a bit of a random one, but by the time I decided to do this, it was basically the only bank that still had an application deadline open, which is a terrible, terrible reason. But they also offered a rotation program, which I thought was quite good because for me, I didn't really know what I wanted to do. And you could work across both M&A, leverage finance, and the trading floor. So I got both of those opportunities, both the masters and the job. And I decided on the job because basically I realized I didn't have any money to do the masters and I had to take out a massive loan. So it's pretty functional reason for deciding to go ahead with it. And yeah, I basically ended up becoming quite apparent to me that the trading floor was actually the place for me, not M&A and Lev Fin. And I guess I'd always thought investment banking was M&A, but actually the trading floor was way more interesting. And I ended up in CLO structuring, which at the time, CIBC were actually a relatively like a leader in that space in what was effectively like a new market because these were like the very first European CLOs that were being issued around that time. So it was quite an interesting place to start. And so I stayed on the sell side doing CLO structuring for quite a few years. And then I moved to Alcentra in 2012, and that was completely unplanned because that was, I guess, not that long after the GFC, and the CLO market was still very young then. I didn't really know that a buy-side career investing in CLO tranches would be a thing at all. It just sounded really exciting. So I moved over, and that was, I'd say, a pretty transformational development in terms of my career. And it came as a complete surprise. And I was essentially offered the opportunity by the former CEO of Alcentra and CIO of Alcentra who knew me from my role structuring CLOs. So they worked with me in the past and thought I was good and offered me the job basically. And I, jumped in and went for it, and it's turned out, really well.
It's fascinating. Well, we will get into some of the weeds of structured credit in just a minute. I just want to ask you about something you said about not having had any formal guidance, formal or informal, or mentorship around those career decisions and what to choose. Do you think that's as easy today? I mean, I think it's fair to say there was a different landscape then. We probably had the official milk round when, actual people came to actual campuses and interviewed, and there seemed to be less noise around the job application process. Do you think it's possible to drift in a little bit today, or does it need to be more structured?
I think it's possible, but I think it's hard. I mean, it was hard. It was super competitive when I was young, and I somehow figured my way in. But I think it's probably harder today. It seems like a very almost an industrialized process. I do a lot of work in terms of interviewing graduates and things, and they are so much better prepared than I was. Like if I think back to my interview at CIBC now, I cringe at some of the things I said. And the kids these days, I think, are much better prepped. And I think, I think it's at the university level. I think they're better coached today than I was. And I think also maybe in finance, the diversity of people's backgrounds isn't quite what it should be. And I think part of that is because of this family coaching element or guidance. I had no guidance. I was just sort of trying to figure out something interesting that would keep my brain active, but also, pay well and be rewarding. So it was, I just sort of ended up here. I think I got pretty lucky, really, if I think back.
Well, if we move forward now to this area of structured credit, could you kind of give us a little bit of the lie of the land today? Where do you think the opportunities are? What excites you about working in this area today?
So in terms of what excites me about working in the area, I think what I really enjoy about it is that I think it really suits my skill set. It's very analytical, numerate kind of industry. It's a little bit more numerate than some other parts of finance. I just really like investing in these assets as well, because I've kind of been doing it for so long. It's like I'm an expert in the product, and I really enjoyed actually making that transition from being sort of an expert in the product who was structuring the CLOs to being an investor in the product. And that's actually a completely different skill set. And I didn't know that I was going to be any good at that, if you see what I mean. So that's been great. And in terms of what excites me about it today, personally, I really think that the junior mezz in CLOs in particular is really, really attractive. I think the yields you get there versus the risk, it's kind of disproportionately compensated, I would say, for the risk you're taking. And I think ultimately, if I could put all of my money in it, I probably would. I'm not allowed to for compliance reasons. I obviously invest in the funds that we manage. I'm not allowed to compete with our investors, but I think it's really attractive. I think what excites me about the asset class as well now is it's growing so much. And I don't just mean the CLO market, but structured credit more broadly. It's just getting so much more attention from a wide range of investors. So I think it's really exciting to be part of something that's growing and actually finally getting the attention that I think it deserves as an asset class. And in the CLO market specifically, we've got ETFs, ETFs on CLOs now, and that's obviously getting investors talking. It's, the recent marketing trips I've done, everybody's talking about CLO ETFs and what it means for the market. And I think it's reaching another set of investors that maybe wouldn't have invested in the asset class before. So I think it's an asset class which is really growing and getting a lot more investor attention, and from different investors as well, people who wouldn't have looked at the space in the past.
We're going to take a short break to hear from one of our sponsors of this series, Eagle Point Credit Management. I sat down with Tom Majewski, founder and managing partner of Eagle Point. I asked him how he thought the client level of understanding of CIO instruments was evolving.
So when we set up Eagle Point in 2012, 9 out of 10 people that we called wouldn't even take our call. That sounds a lot like CDOs and no thank you. I don't think the committee is going to be interested. I don't think the trustees are going to be interested. I'm pleased to report that's probably only 7 out of 10 people won't take our call now. And what that's underpinned by is performance. And we saw how CLOs performed through the financial crisis. 96% of all CLOs issued prior to the financial crisis had a positive return to the equity class, despite unprecedented levels of corporate defaults. Well, we had COVID happen, and indeed, the price of loans fell precipitously. I think loans were down even more than stocks in March of 2020, odd as that sounds. But if you were an investor in a 2019 vintage CLO, you've probably had a very good experience overall in that the CLO structure performed just as it did in 2007, 8, and 9. It worked. There were no forced liquidations. CLOs proved to be a very steady hand, and the ability to reinvest, particularly in dark days, proved to be extraordinarily valuable.
And now back to the show. My next question is around investor understanding and appetite. Maybe could you touch on those ETFs a little? What do they capture? What do they not capture? Are they a suitable proxy for the asset class, or where do you pay, I suppose, for that liquidity in terms of returns or diversification? And then we can evolve into talking about general investor understanding. One of the questions that comes to mind, and sorry to throw so many things into one question, is around some of the reputation of this asset class after the GFC. Right before you joined Alcentra, after the GFC, and just the sense of credit worthiness today?
Yeah, well, let's take that bit first. I think one of the reasons the asset class is now getting more attention, it's not just the ETF thing, it's also just, I think, the asset class has weathered several dislocations and cycles since the GFC, which was essentially the first major test of the market, right? And CLOs, I think, often get very confused with CDOs in investors' minds. And I think that difference is now starting to become clear to people because the asset class has performed well through periods of dislocation. So I think that the asset class and investor base are evolving because of that. So I think that's great. I think that ETFs, I don't necessarily see them as a massively positive or massively negative development. I think it's just great that effectively it means that more people are thinking about CLOs and thinking about the asset class. I think it taps into a slightly different investor base than would invest in a more traditional fund format, which therefore expands the potential investor base for the product. It's a different kind of asset class. As a fund manager, it's a different thing to get your head around managing an ETF versus a fund, but I think the asset class can take it the kind of IG part of the structure in terms of liquidity. But I do observe that some of the fees that the ETFs charge on a running basis are maybe a little bit higher than we might charge on a traditional fund. And you can obviously have the bid-ask spread when you're trading the shares. So there are additional dealing costs. But then on the other side, the investor gets more liquidity. So I think it has a valid place in the market, to be honest. I think it's probably overall a positive development for the asset class in terms of broadening its appeal.
And outside of ETFs, what kind of liquidity should an investor expect in a structured credit investment? What is the kind of minimum liquidity that could be offered?
So ETFs, you're essentially getting intraday liquidity. I think the biggest ETFs are AAA focused. I think in a similar AAA focused fund in a normal fund structure, you would expect probably ideally weekly or maybe daily liquidity. So it's not necessarily a huge mismatch, but not all funds offer daily or weekly liquidity in that space. They probably could, but figuring out the correct redemption charges to take into account if you have redemptions during periods of stressed market where you have a higher bid offer spread, that's the devil in the detail, right? In terms of further down the capital structure in MES, you probably would typically see weekly or monthly liquidity. And then when you get lower down the capital structure to the subordinated tranches, you're probably looking at quarterly or maybe monthly liquidity through to closed-ended funds that are 5 years to 10 years in length. So there's a real range. And there's pros and cons to having these different liquidity structures, both for the portfolio management team and also the investors.
And integrating then something that's become very much on investors' minds, particularly in Europe, is sustainable finance principles. Is this something that can be woven into a structured credit approach?
It's hard. We really try. The reason it's hard is because we are not actually the people who are engaging with the underlying borrowers. We're not directly engaging with the companies. We're relying on the CLO managers to do that. So that's quite challenging for us to therefore have a direct influence. We can engage with CLO managers and make sure they have proper engagement and policies in place and are doing all the right things. But the problem we find is that the level that how seriously different managers take this varies quite a bit. And some people, you do get the impression, some managers, I get the impression it's a bit of a tick box exercise. And I feel like they do things like outsource some of the reporting and things. They're not really directly engaging with the borrowers. And therefore, it's kind of hard to see whether they're really having any, the CLO managers, it's hard to see whether they're having any direct impact, really. An example of this would be a lot of managers we speak to are quite reluctant to ask the underlying borrowers to disclose their carbon emissions data. They're quite happy to just rely on estimates or third-party providers who provide estimates rather than actually engaging with the company. So it feels to some extent sometimes like a bit of a tick box exercise. And we're trying to push people to be a little bit more thoughtful about it, but it's tricky. And quite frankly, it's not made any easier by the divergence of views on this between the US and Europe, and even some states within the US have very divergent views on this. So we have to tread a very fine line, I would say, as an investor and a manager. It's quite tricky.
And a little bit tied to that, but really tied to some points we discussed earlier around diversity in finance and different backgrounds and different cognitive diversity, different perhaps academic backgrounds. I'd love to hear your comment on that. Are you at a PM level are still an exception in the world of finance? And I know that there are various stages to get to that level, which can sometimes lead to people dropping out of the workforce. Any observations over the course of your career on the grade, I suppose, that you might give the financial industry for diversity and inclusion?
I wouldn't say I have a particularly positive assessment of it. So if I think about finance in general, I don't know, a grade, maybe 6 out of 10. But it's interesting because I really do think that a lot of banks and asset managers are trying to do the right thing in terms of trying to broaden out the scope of hiring and, trying to encourage more female applicants, but I don't know if it's actually working. So it's kind of difficult to know what they're doing wrong or why it's not working. But I can say that when we look at applicants, as I said, I'm involved a lot in sort of more graduate recruitment. And when we look at applicants, for example, we have a 1-year internship program in the London office. And when we look at the applicants, it's very heavily dominated by males. And it's actually very hard to find female candidates. And when we do see them, the banks aggressively are chasing them. So it's actually quite difficult to get women to join in the first place, which obviously is pretty fundamental to solve the female-male imbalance, particularly at the more senior level, is if you don't get any junior female people, they're not going to become senior female people. And so that's challenging. I think it probably starts in school. Like, if I think about it, the issue fundamentally is why are more women not applying to work in finance? And I think in particular asset management, because I think maybe you hear about the big banks with the brand names and maybe people don't think so much about asset management. I think that starts in school. I think also maybe finance doesn't have the best reputation in terms of with the youth of today. When I was a kid, it was a very desirable career choice, I think. And maybe I wasn't aware of that, but I think other people were. And I think, maybe that's changed a bit. And I think we maybe need to try a bit harder to reach people at a younger age and be seen as a more attractive career choice versus tech or something else. And maybe it does have something to do with workplace flexibility to some extent, but I'm not sure I have the answer, to be honest. But unfortunately, what I see is that women are definitely underrepresented, and also people coming from lower socioeconomic background. I think that's also something I see a lot. We've been involved in a scheme called Investment 2020, where we take 1-year interns through that scheme as well, which actually I have a person on my team who came in through that channel, and we've got other people across the firm who've done the same. So I really like that scheme, and I think that kind of outreach should be encouraged. So I think we should probably be doing more in this area as an industry. But interestingly, so I guess I'm talking about finance in general there. When I look at the CLO market, which is obviously a very niche part of finance, there are actually quite a lot of female portfolio managers at a very senior level, like some of my competitors and also some of the CLO managers who were managing the CLO portfolios. And also on the sell side, there's some very successful senior women in the CLO market. So, and I'm sure anyone who knows anything about the CLO market would agree with me, is actually women are quite well represented in the CLO market, strangely. And I don't know why that is, but it's great to see. But I wish it were the same across the rest of finance.
And it's an interesting time, I think, to be having this discussion because, a lot of the initiatives haven't changed, but I think we've had to be a little bit more razor sharp about the purpose of these initiatives. I've always been pretty clear that for me, the purpose of these initiatives is to make finance better, to work better, to represent its customers better, and to generally have better cognitive diversity. It's not to make finance look a certain way or tick boxes. It's always been in the belief that greater cognitive diversity generally strengthens an organization. And I think any discussions around culture would back that up. But I think it is important just to reiterate why I asked the question even, because it's not about asking the question to tick boxes. It's about asking the question because I, as a participant in the industry and as passionate about it as you are, I think in terms of why it's a great place to have a career, make a living, to be intellectually stimulated and beyond. I just think that it is a richer industry for its diversity. And I'm glad to see that that's already been recognized in the echelons of structured credit. We're going to take a short break to hear from one of the sponsors of this series, Benefit Street Partners. I sat down with Rich Byrne, President and CEO of Benefit Street Partners, and asked him about what his leadership style was.
My leadership advice is to lead by example. Nobody wants to follow somebody that, the general that says, oh, go take the hill. And I'll be back here, in my little hut. Good luck to you guys. You generally will give your all for that general that gets on their horse or whatever kind of battle you're in and rides up front, along with the rank and file troops. And I think the same applies in work. It's like you should have the same ethos, the same work ethic.
And now back to the show. I'd love to move on to some reflections, and we've already had a few of these in here, but if you were to look back, say, at your career so far, we talked about not having specific mentors and guides, but were there key people that sort of through the various stages where you did make leaps or advances that influenced you in a particular way?
Yeah, I definitely would say I definitely was lacking in senior career mentors or influences, and I don't think that's held me back, but maybe that was luck rather than anything else. I'm not sure. There are definitely some people who were sell-side colleagues who are now colleagues and friends. So Laura Cody, who used to work with me at Citigroup, and Dimitris Papadopoulos, who used to work with me back at CIBC, they're both still in the CLO market. They've definitely had an impact on my career in a positive way. It's quite funny, like when I was at CIBC doing those rotations, Dimitris was the one who recommended to his boss at the time that they should hire me as a grad on the desk. And Laura and I went through the GFC together at Citi. I think we kind of kept each other sane. And she was actually the person who really encouraged me to go for the Alcentra opportunity back in 2012. So there are definitely people who've had an influence on me through my career. I also think the David Forbes Nixon and Paul Hatfield, who were the CEO and CIO at Alcentra when I was hired in 2012, they obviously had a big impact on my career because they completely changed the course of my career. Because actually I was planning on leaving finance completely and doing something different because I'd kind of got bored of being in the CLO market post GFC when in Europe not that much was happening. And actually they obviously spotted my potential to have an impact in their firm as a CLO investor. So it completely changed the course from going from sell side to buy side and becoming an investor. So they did completely change the course of my career effectively. So yeah, they weren't mentors as such, but they definitely had a big impact. And I think moving from the sell side to the buy side isn't always the easiest thing to do, because just because you know your product doesn't mean to say you're going to be a good investor. Actually, being good at one doesn't mean you're good at the other. And they're actually quite different skill sets. Being a secondary market trader is different from being a long-term investor in the asset class and managing portfolios that are looking to do very different things for different clients. So it's a different skill set. So it's not an easy transition to make always. And obviously, I'm lucky it's gone very well.
Oh, that's fantastic to hear. And the last question then is around any creed or motto that you live by, or any words of wisdom you might have for your younger self. Anything you can share with us there?
I think one thing that I often think about is enjoy the journey. Life's not just about the destination, right? Like I think I've never really had this process in my mind of this is where I want to be in the future. It's more enjoy life, enjoy the experiences that you have along the way. It's just effectively life's short, right? Like you never know what's going to happen. So enjoy it. I suppose that speaks to having an interesting career, right? You don't want to be slaving away at work in a job that you hate. And that was why, I guess it wasn't obvious to me what I wanted to do, but I wanted to do something that interested me academically and kept me stimulated. And I do really enjoy my job. So, I'm pretty lucky to have a job that I enjoy, I think. I actually think there's a lot of people in life who probably don't have that, go through life kind of not really enjoying their job. So I think I try to just enjoy every moment. I think, I've lost a few family members through the last few years that were very young, and that's had a big impact on me. And I think that's driven that motto and that thought process.
Well, I think that's a wonderful place to leave it. Cathy, you make it sound unremarkable, your journey. You make it sound like it was all relatively straightforward, but I do think it is quite remarkable to have landed where you have in such a complex area that is less well understood, and to be one of the few leaders in this area that can really set the stage and set the example for others to follow. And thank you so much for coming here and sharing your insights with us.
Yeah, thank you.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investment professionals and their journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.